how did I get interested in the Fed? Goes back to 1974. I have a law degree also from Boston University. And when I was about to graduate from law school, there were on-campus interviews from various employers. And I signed up for a series of interviews. Wound up with a job offer in Boston and a job offer in New York, and it was sort of the last good time to be a law student because that just doesn't happen anymore. It's very hard to get job offers. So anyway, I had signed up for an interview with the Federal Reserve Bank of New York legal department, and then I forgot about it, and on the day of the interview, the placement office contacted me and said, the fellow from New York wants to talk to you. So I went and did the interview, and he invited me down for a follow-up at the Fed of New York, and I didn't really know that much about the Fed at that point. Was hired, started in the summer of 1974, and when I walked in the door, they said, well, you've got to go over to Franklin National Bank. And Franklin was the first big bank failure in the United States since the 1930s. And so I was to go over and assist the bank examiners in reading through the loan documents. And they decided, one of the things that attracted them to me was that when I was in school, I took all the courses that were related to negotiable instruments law, bankruptcy, corporate finance, things like that. And most people would take, I guess, today would sign up for intellectual property and environmental law and stuff like that. But if you wanted to work on Wall Street in those days, you needed to know something about negotiable instruments law. So they sent me over to help the examiners, and soon they decided that I was a monetary affairs lawyer. Why was that? And the answer is because I had lived in France for a year and traveled around Europe. And they said, therefore, you must know something about foreign exchange. And I said, yeah, right. So anyway, so I started getting questions thrown at me from the various departments of the bank that dealt with the discount window, open market trading desk, the foreign exchange desk. And I said, well, geez, I'm going to have to learn some more economics to cope with the questions I'm being asked. And luckily at the time, Cambridge University Press and Macmillan were just finishing the publication of the complete writings of John Maynard Keynes, about 30 volumes. And I was interested in war finance, in part because of Keynes's book, Economic Consequences of Peace, 1919. How many of you have read that book or know about it? See one hand. Anyone else? Among the older generation of economists, if you did a survey and said, we used to ask this, in fact, for people applying to the summer program here, we would ask, what books influenced your decision to study economics? Okay? And rarely did the students cite that book, Economic Consequences of the Peace. But the older generation, those my age and slightly younger, many of them would say that was the book. And another popular candidate was Hayek's Road to Serfdom. How many of you read that? Good, yes, anyway. At least if you've read that, you're inoculated against the worst that can happen. So anyway, and of course, you know the story that Keynes and Hayek were actually friends, and Keynes helped get Hayek out of Europe and get a job in England for a while. How many of you have seen the Commanding Heights video series? public television originally. It's available either as a CD-ROM set or you can look at it online, the Commanding Heights videos. But I highly recommend that you see at least episode 1, chapter 1. It's a 3-part series. Each episode is 2 hours. And episode 1 is called The Battle of Ideas, and it's essentially Keynes versus Hayek. They were chosen as the representative thinkers in economics for the 20th century. And as the show ends, Hayek is winning out over Keynes because by the late 80s, 1990s, people had concluded that the old planned economy and the Phillips Curve aren't really worth much. And many of us thought that we'd never have to deal with the Phillips Curve again. How many of you know what the Phillips Curve is, by the way? Most of you, good. Anyway, but it's back. At the Board of Governors staff, it never went away, really. There would always be some senior researcher who was enamored of his models, and the models depended on a Phillips Curve analysis of the economy, and the kind of monetary policy would feed into that model in order to tell the Federal Open Market Committee what to do. So that's how the Phillips Curve made its resurgence, especially after around the year 2000. It was clear that while Alan Greenspan was chairman, he was being encouraged by the senior staff to adjust monetary policy based on the outlook for unemployment. And that continued all the way to the 2008 Great Financial Crisis. And of course, since then, it seems for a while, the unemployment stuff was shoved aside in favor of let's save the banks. And after the banking crisis sort of receded a little, we're back dealing with the Phillips Curve again. And I'm beginning to wonder if we'll ever get back to the quantity theory of money. When Alan Meltzer talks in about a month, you will hear him make some extensive comments about this and the role that the Phillips Curve models play in Fed economic planning and in the policy-making circles of the board. In that slide that was shown about the famous economists, starting with Friedman going across, there's about 15 of them listed, and before you came in, Seth Hoffman and I were going through the list, seeing how many of them I knew. Well, some of them were dead before I was around, like Wesley Clare Mitchell and Benjamin Strong, for example. But I probably knew about 2/3 of the people shown in that slide. So anyway, that's partly just a function of having worked at the Federal Reserve and being as old as I am. How many times did I meet Alan Greenspan, for example? And the answer is I rode in an elevator with him once at the New York Fed building. So anyway. Okay. Let's talk about the Fed and its purposes and functions, the official slideshow. This talk is largely derived from a paper I did. It was published about a year ago. The reference you'll see buried in the slides, but it's Levy Economics Institute at Bard College, working paper 763, The Problem of Excess Reserves Then and Now. So a comparison of the excess reserve problem in the 1930s versus the excess reserve issues today at the Fed. And Levy published that in May of 2013. So let's go ahead with slides and I'll show you what we're doing. So my first main point is the Federal Reserve's Board of Governors is a political oversight body. It has no operational balance sheet of its own to pay its bills. It has to assess the reserve banks. and the reserve banks send in money and the board spends it. But the board controls what the Federal Reserve banks do with their own operational balance sheets. Meltzer, in his talk, will go into that a little bit, noting that at various times in the last 100 years, the Fed was created in 1913 and began operations in 1914, by the way, so it's the 100th anniversary year. And that's why we're doing this course on the history of the Federal Reserve at Chautauqua in about 3 weeks. And Alan Meltzer is one of my speakers. But anyway, from time to time, the reserve banks would operate independently of the board. And at other times, especially when there was a strong chairman with political clout emanating from the White House, Arthur Burns is the classic illustration of that. Burns was chairman from 70 to 78. Whenever you had a strong chairman, they would try to control the individual reserve bank budgets, going so far as to review the appointments of officers and directors of each reserve bank. And so in my day, it was in the Burns era. And luckily, I was at New York, which was still a somewhat independent institution then. But if I had worked at a regional reserve bank in those days, some senior staffer at the Board of Governors would have been going through my biography, deciding whether I was fit to be an officer at the Cleveland Fed, for example. And I think that's intolerable, but that's the way it is, and it will only... We'll be able to get rid of it only if enough reserve banks actively resist and recruit senators to weigh in on their behalf. Okay, so the board tries to control what the reserve banks do. Some reserve banks resist, some dissent. I would guess on monetary policy today, which essentially still is print money with wild abandon, how many reserve banks go along with that? And the answer is there may be 2 or 3 that are avid cheerleaders for that policy, 3 or 4 who just follow whatever the majority sentiment is at the Board of Governors or the chairman. And then the rest are, to a greater or a lesser degree, in dissent. My favorite reserve bank lately is Kansas City Fed. How come? And the answer is every time they get a chance to vote on monetary policy, they dissent. And this goes back for 4 years. So whenever Kansas City has a vote, there are 8 votes per year, and you get 8 dissents out of Kansas City. So that's not bad in my book. But I asked this question here, how does the board control what the reserve banks do? And there are 2 main avenues. One is, if you look up online, the Federal Reserve Act, look at Section 4 of the Federal Reserve Act, and you'll see, I think it's in paragraph 24, that the board is authorized to exercise general supervision over the affairs of the reserve banks. And you say, well, wait a minute. When that statute was drafted in 1913, the founders of the Federal Reserve System definitely intended that you would not have one single unitary central bank. They wanted it dispersed across the country. There had been a history in the 19th century, especially dealing with the first and, more importantly, the second Bank of the United States, which functioned sort of as a rudimentary central bank. People didn't like it out there in the heartland. They didn't like the old central bank. And the idea that you would have one bank, especially one bank headquartered in New York, was anathema. You could have never gotten such a bill through Congress in 1913. So the decision was to create between 8 and 12 regional reserve banks who would have operational control of what the system was doing. and to scatter them around the country. New York is one of the 12, and the original Federal Reserve bill that then Representative Carter Glass of Virginia, who was the Wilson administration's point man in the House for this bill. Well, Glass's original concept was that there would be no board of governors, no politically appointed board sitting in Washington, D.C., supervising the Federal Reserve System. Wilson, who was, in my book, a centralizing power grabber, but Wilson said, "This is intolerable. I must have a device through which I can influence what happens directly at the Fed. So I want you, Carter Glass, to go back and rewrite the bill to overlay a board appointed by me and sitting in Washington to supervise this system." And so Senator Robert Owen of Oklahoma carried the ball for the administration on that point, getting the Federal Reserve Board through. Glass didn't like it, but argued for that provision when the bill went back to the House. And he sold it to the House with the argument that the board would be sort of like the Supreme Court of Finance. They have long appointments. I think the initial appointments were for 10 years. And they will be prominent economists and others responsible in the field of finance, and they will make disinterested decisions, sort of like the Supreme Court. Okay? And that was how the board came to us. But what is the organization or institution where the board, which has no funds of its own, what is the organization or institution through which the board exercises the largest role in determining monetary policy? What's the name of that thing? Federal Open Market Committee, right? And what is that? And this is hard to explain for people who don't understand the structure of the Federal Reserve. Today, the committee meets 8 times a year, so it's roughly every 6 weeks, in Washington at the headquarters of the board. And the Banking Act of 1935, you have to remember this also, originally, in the original conception, there were 5 governors of the board, plus the Secretary of the Treasury, plus the Comptroller of the Currency. And the Comptroller is the chief regulator of national banks, but he is an official within the Treasury Department. So the Treasury essentially had 2 votes on the Board of Governors. Well, sort of. The Treasury Secretary and the Comptroller were their, quote, ex officio, which means that they could participate in the deliberations, but they didn't have a formal vote. But it would take a fair amount of political courage, the type you don't normally see in Washington, for people who disagree with the Treasury Secretary to oppose him on a vote with the Secretary sitting right there in the room. Banking Act of 35 revised the structure of the Federal Open Market Committee into more or less its current form, and it was refigured as follows. There will be 12 members of the committee. 7 of them are the governors of the Federal Reserve Board, and 5 of them are presidents of the Federal Reserve banks, who serve typically on a rotating basis, with the exception that New York has a permanent seat and a permanent vote. Okay? So there have been times when a majority of the FOMC would oppose the current monetary policy decided upon by the board. But those times are comparatively rare. The last time I recall active opposition to that extent was in the mid-1980s. There was one point when Paul Volcker offered to resign around 1985 when a revolt led by the vice chairman, Preston Martin, caused Volcker to lose a discount rate vote 4-3 at the Board of Governors. So having lost the vote, Volcker offered to resign. But the White House refused to take the resignation, and Volcker stayed on a couple more years, but Martin eventually left. So it's hard to lead an internal revolt against the board within the board. But hey, if you're at Cleveland, St. Louis, Kansas City, this is imaginable and somewhat easier to do. Cleveland and Chicago alternate votes. They get to vote every other year. When Cleveland is voting this year, for example, Chicago will vote next year. This region, Boston, is in a rotation that I believe includes Boston, Philadelphia, and Richmond. So the president of the Boston Fed gets to vote once every 3 years. Each reserve bank has a research staff, and for those of you who go on to graduate school, you might want to look into that, applying either for one of their summer internship programs once you're sort of at the master's level, or beyond, or when you're getting out, a PhD in economics or finance or some other related field, you might want to look into joining the Federal Reserve Bank's research staffs. The board also has a large research staff in Washington. And among the reserve banks, New York, of course, would have the largest staff, but there are staffs at each regional reserve bank. Supervision. Banks are regulated in this country at the national level. I guess there's been national regulation of banks since around 1863 under the National Bank Act. The controller of the currency, as I said, is the chief regulator of national banks. But in 1913, when the Fed's Act was passed, it was provided that all national banks would be required to join the Federal Reserve System, and state chartered banks would be allowed to join but not required to do so. And that was a state of play all the way down to about 1980, when under the Monetary Control Act, all banks are required to maintain reserves at the Fed, whether they join or not. So at that point, a lot of banks gave up and said, we give up, we'll go ahead and join if we got to maintain reserves anyway. Today, my assessment is that about 1/2 of the reserve banks, to a greater or a lesser degree, disagree, some more strongly than others, Kansas City, for example, disagree with the current course of monetary policy. There was a hidden article in the financial press a couple of days ago saying that the Kansas City Fed, which controls the annual Jackson Hole Conference of Central Bankers, the Fed this year is not inviting, the Kansas City Fed is not inviting a lot of economists from the board staff and from some of the reserve banks who have been supportive of the current monetary policy.
They've also uninvited the Wall Street Journal to cover.
Yes. And that's in part because the Wall Street Journal, usually their lead reporter is sort of a mouthpiece for the chairman's office. And generally, this is true at the Times as well. So instead, the Kansas City Fed is inviting labor economists, specialists in unemployment. This is going to be an interesting exercise. My reading of it is that the Kansas City Fed is going to say to Janet Yellen, you want to keep printing money to reduce unemployment, do you? Well, we're going to surround you with experts who will tell you that you can't get there, reduced unemployment, by continuing to print money. So they're going to try to make the main case to her in language that hopefully she will understand. And that leads us to the main subject of the slideshow and my paper, excess reserves. Okay, we'll go to this link in a moment, if hopefully it's live. But look at the board's weekly H-4-1 release online. It's a proxy for the Fed's balance sheet, which actually appears a little farther down in a table in the same release. The first table is the significant one because it has the operational factors and investments and liabilities that are the Fed's monetary policy operations. Let me see if I can get us to the link now. It's on the Federal Reserve Board's website all the time. It is released weekly on Thursdays at 4 o'clock with data as of the day of the close of business the day before, Wednesday afternoon data. So here we see, they call it factors affecting the reserve balances of depository institutions. And it's the same thing as the condition statement of the Federal Reserve banks. In the world that we live in, where there is no gold in the system officially, what is money? And the classic definition of the monetary base, we'll get to M1 and M2 later, the monetary base is the stuff that the central bank controls and that the rest of society uses as money or its equivalent. Okay? What are the components of the monetary base? And that's in the liabilities portion, a little further down. Let me get to that. Okay. So what are the components of the monetary base? Currency in circulation. What's the main form of currency you have in your wallet? Federal Reserve notes, right? By law, there's a small fraction, I think it's only about $340 million, of Treasury currency that still circulates. But it's been a long time since I got any of that just in an ordinary transaction, change at the store or something. I haven't seen one in probably 15 years. Have you, Neil, or you, Fred? No. All right. How can you tell Treasury currency from Federal Reserve currency? They look the same. They're also green and have the same denominations. And the answer is all that language about Federal Reserve note and stuff like that, it's not on there. Also, if you turn it over and look at the back, "In God We Trust" is not on there. When they decided in the 50s to put "In God We Trust" on the currency, the act was written so that it applied only to Federal Reserve notes, but it doesn't apply to Treasury currency. Okay, but if you ever get one, you might want to keep it and frame it. Anyway, so currency in circulation is the number one component of the monetary base. And what's the other main component of the monetary base? Deposits with Federal Reserve banks. Other than reserve balances, It is there we are. It's reserve balances at the Fed plus currency and circulation. That's monetary base, those two numbers. So that means we have today about $3.9 trillion of monetary base. The main focus of what I'm talking about today is the reserve balances number. That changes a lot. Here, this shows you the year-over-year change. This tells you that about $500 billion has been added to reserves over the last year. Now, in theory, you learn in money and banking that the way credit expands, the way banks create money or credit, is that you go in, you take out a loan, say you buy a car, you sign a note for a car loan for, say, $15,000. Does the bank have $15,000 in the vault that it goes and hands to you that it collected from somebody else? No. In a fractional reserve banking system, what it does is that the bank creates a bookkeeping entry for $15,000 showing the asset is your loan, and the bank's liability is a new deposit account that they credit, or if they hand you a check, internally they would have a deposit account that they debit for the amount of the check that they are giving you. They created the $15,000 out of thin air. But the Fed's rules require that the banks maintain a reserve balance equal to 10% of demand liabilities. So, out of the 15,000, the bank has to separately send a check for 15,000 or a wire transfer these days to the appropriate Federal Reserve Bank. Okay? So reserve balances go up as required reserve balances go up as banks make loans, and that's how money expands. So I'm looking over there, reserves went up $500 billion. Do you think the banks made $500 billion of loans in the last year? What do you think? No. We'll see those numbers shortly. So one of the main arguments that the dissenters have with Chairman Yellen is, why are you, and we had this argument with Bernanke before, why are you continuing in this quantitative easing policy if it's not really getting you where you say you want to go? You're engaged in purchases of government securities. Let's go back up to the asset side. Okay. The main action is up here near the top. Securities held outright, $4.1 trillion currently. Okay, and that is, get this, $878 billion more than a year ago. But we just saw that 550 billion almost of that 800 went into reserves. These are balances held idly at the Fed. They're not being loaned out. Okay, now why, you gotta think about this, why would a banker choose to just park the money at the Fed instead of lending it out at interest so he can earn a return on these assets? Why would a banker choose to do that? Well, ultimately, any other reason. I'll come back to your point. Maybe there's a recession going on, and the banker might decide there aren't enough credit-worthy borrowers out there to absorb this $800 billion of new money that the Fed has created. Similarly, I live in Cleveland. I know a lot of manufacturers. Their attitude is, show me the demand. When demand increases, I will invest more. And that means I would go down to the bank and borrow some money. But in the absence of demand, why should I borrow money? Okay? So what else has the Fed chosen to do? Well, that's Treasury Securities. The Fed has added $450 billion of Treasury purchases over the last year. They've decided further to buy only at the long end of the market, so that nearly all the $450 billion was purchased with maturities of 5 years or longer, and probably 60% of it has maturities of 10 years or longer. In classic central banking theory, you would want to roughly match the maturities of your liabilities on the one side and the assets on the other, so that if a significant part of your liabilities are demand liabilities, deposit accounts, reserve accounts that can be withdrawn on a moment's notice, you might want to hold short-term securities. Before the crisis, virtually the entirety of the Fed's balance sheet was at the short end. Maturities of up to 90 days, up to 1 year, up to 2 years. Practice since the 1970s, custom among Treasury officials and central bankers, has been that you'll regard as a current asset anything maturing under 2 years. Okay? Is there a natural market, and I'll look at my friend Neil over there, is there a natural market for the long end of Treasury securities, 10, 20, 30 years? Who buys that stuff usually?
Life insurance and pension.
Insurance companies and pension funds, because they're trying to match with an asset the liabilities they're going to have to pay out. And if you're 35 years old and going to retire at age 65, the perfect match would be to go out and buy a 30-year Treasury security, right? So, anyway, the Fed now has elbowed out the insurance companies from the long end of the Treasury market. Whenever new stuff is sold, the Fed buys it, and I think something like 80 or 90% of the long end of the market for the last year or two has been going to the Fed and not to the insurance companies, right?
I don't know the exact percentage, but a large fraction.
Yeah. Okay. What else do I learn from this balance sheet? Mortgage-backed securities. Boy, the Fed's got a lot of them. 1.7 trillion almost. And out there I see that also is up 450 billion from a year ago. Now when the chairman, Bernanke at the time, announced QE3, the current quantitative easing program, someone stood up at the press conference when he announced it and said, "Why are you buying mortgage-backed securities in this quantity? Wouldn't it be better and more efficient for the economy to just finance the refinancing of existing homeowners' mortgages to lower the interest rates? And maybe you would stop the foreclosure wave." And Bernanke's reply was a Phillips Curve reply. What did he say? He said, "We believe that if we buy the mortgage-backed securities, it will stimulate credit to the housing industry, and our target is new housing construction, which creates more jobs than you would get from a mere refinancing." Okay, and if you don't believe me, go check out the Bernanke press conference, roughly September 20th, 2012, and it should be available somewhere on the board's website, and I'm sure a lot of people also copied it out there on YouTube or whatever, but you can see it. All right, so Why is the Fed doing this? To stimulate new housing construction. Is there anyone here from Arizona or Las Vegas or Southern California? No. But what happened in such places in the run-up to the crisis? They vastly overbuilt, didn't they? So housing prices in places like Phoenix and Las Vegas fell by more than 50% off the peak. Do you think they need more housing construction in Phoenix and Las Vegas? Or do they need absorption of what's already out there? And if you go to a builder and say, I want you to build new housing construction, is he going to do it? They may be doing it around Albany, I don't know, but are they going to do it in Albany, Buffalo, Rochester, Cleveland, or are they going to go to Florida, Texas, Arizona, Las Vegas, the places that are already overbuilt? So I want to hear about the economic efficiency of that. Okay, so the discount window lending, the emergency lending that the Fed engaged in back right after the crisis, that's largely gone away. It's almost entirely been repaid. So discount window credit outstanding was only $219 million last week. And the main one you want to focus on is this one, Term Asset-Backed Securities Loan Facility, $49 million still outstanding. Any of you ever read Rolling Stone? Do you know who Matt Taibbi is? Frequently covers financial topics to Rolling Stone. He's the inventor of the famous vampire squid analogy for Goldman Sachs. Well, anyway, he has a good article that's related to this line called The Real Housewives of Wall Street. It turned out that when the Fed announced this facility, they were trying to get people to invest in asset-backed commercial paper and other asset-backed securities. So the Fed said, if you'll buy the stuff, we'll make you a loan at favorable rates, so you will always have what bankers call positive carry, a favorable interest rate spread between what you're paying us to borrow the money and the yield you're getting on that paper. So maybe you'll pay the Fed 0.75% annualized, and the paper would yield, say, 3.25%, and you'll be locking in a 2.5% return, and that's not bad in this environment. Okay? So who went out and bought the paper under this facility? And the answer is the wife and the sister of the head of Morgan Stanley, the wives or girlfriends of senior Goldman Sachs officials, and the like. And Matt Taibbi wrote it up in an article that you could probably look up online, The Real Housewives of Wall Street. But this is the credit line that financed them. The Term Asset-Backed Securities Loan Facility, and at its peak at the inception, that was over $1 billion. Okay, so that's not bad for keeping it all in the family. Now, how many reserve banks do you think wanted to do this, the Term Asset-Backed Securities Loan Facility? I can only think of two. Who would those likely candidates be? New York, and who else? Boston. Why Boston? Because what's in Boston on the financial side? The mutual fund industry is in Boston, right? And what do mutual funds buy? Commercial paper, though, in particular, right, for short-term liquidity. And since asset-backed commercial paper had emerged before this crisis, they were the biggest holders of it. Okay, so let's get back out of this if I can figure out how to do so. So on that Fed H41 balance sheet, some of the factors change significantly week to week, month to month, quarterly, annually. those are the factors that you ought to be concerned with in analyzing monetary policy. Let's see what the next slide says. But there are other factors that are the same over extended periods. The latter factors are part of the monetary base, which we described below, reserves at the Fed plus currency in circulation. But these are usually not part of the Fed's array of operational targets between monetary policy deliberations. So what factors on the balance sheet might the Fed choose as near-term operational targets, and what factors might remain stable over time? For example, we noticed that Treasury Securities and Mortgage-Backed Securities both went up about $450 billion each over the last year. So they're obviously working on those things. But what stays stable? What doesn't change? Gold holdings, for example, is an entry for gold certificates on the Fed's balance sheet. SDR, special drawing rights of the IMF. The Fed cashes those for the Treasury under a mistaken view of Congress that there's no harm in doing that, but there is harm. Luckily, it's only about $5 billion, so it doesn't matter much. Other assets on the Fed's balance sheet, which typically includes buildings, grounds, artwork, computers, software investments that are amortized. These things are not monetary policy operational targets. Or putting it cynically, when you learn that the Fed is investing in art and holding it for open market portfolio, it's time for you to buy gold, okay? In fact, I have a friend in Cleveland who's a Turkish economist, studied in Turkey and then came here. And once he started sitting in on FOMC briefings, he started investing in gold, which is a rational response. People say here, why did you come here and why are you interested in gold? And the answer is, if you worked inside the Fed and understood the monetary policy operations, you would be interested in gold too. Okay. So let's see some of the highlights and lowlights of the balance sheets of recent years since the crisis, and the tables will come in. And for figuring out what is M1, M2, the definitions are at the bottom. The Fed no longer gives Congress an official target for M1 projections going forward because they decided in the mid-'80s that they can't really control closely enough what happens in M1 components, the amount of deposits that show up in checking accounts, for example. So the Fed states a target for M2, which can include some savings accounts and things of that sort, but that's the best we can do in terms of monetary control. And we've already talked about the definition of the monetary base. So here's how the Cleveland Fed, by the way, illustrates the effect of the board's monetary policy actions since the crisis. You should look at that. Guess I should get down, watch it grow. Okay, so it's color coded, but the main thing you need to know is this color brown is the traditional security holdings of the Fed, typically Treasury Securities. This is purchases of long-term treasuries, what we started to do under QE2. Notice it started out here and we started expanding. All we're doing is buying long-term treasuries these days and squeezing out the insurance companies. The traditional portfolio has leveled off at a low level. This is the fall of '08 when the crisis began. You can see the dates if you present this in a horizontal frame, but there we are. And then there are other things the Fed tried. This spike here is the emergency lending to banks that happened in the aftermath of the crisis. And let's see, this one, the lighter brown, which has been expanding a lot, that's mortgage-backed securities, okay? And you'll notice that the level, we're up here just shy of $4.5 trillion on the balance sheet, and we were at about $850 billion when the crisis began. So we have already passed the 5 times barrier. We have quintupled the balance sheet in about 5.5, 6 years. If we escape from this, we'll be the only major industrial economy that ever tried such a thing that did not succumb to hyperinflation in the aftermath. We might get away with it, but there's also a strong possibility that we won't. Minus sign? Yeah. See if it'll do that. Yeah, close that.
And then the minus sign.
That's on the Cleveland Fed's website under research. If you want to look at that, look up the word credit policy easing tools. Okay, are excess reserves a problem? Well, why have comparatively few commercial bank loans been made? And ordinarily, as we said, that's the building block of economic recovery in the face of so much money-creating activity. How has the Fed avoided rapid growth of monetary components like M1 and M2? And should the Fed try to avoid such rapid growth? That's Fred's point. How did the Fed avoid having all this stuff slosh out into the general economy and become money, increasing supply of money, chasing the same or comparable quantity of goods? What do you expect in that environment? Inflation, right? So why is there no inflation? Or the Fed says there's no inflation. And the answer is the Fed pays more than the competing loan demand. If you're a banker, you said there's no demand for loans, and the Fed will pay me 25 basis points, 0.25% annualized, for whatever money I hold at the Fed, and the market rate, meanwhile, is about 0.07, 0.10. I'm going to put it at the Fed instead of putting it out in the market. And so that's what happens. The money just stays at the Fed. No risk. So, and you can withdraw it on demand without notice. So this is all good things from the banker's standpoint. So main point of the paper is there's no reason why the excess reserve problem would go away as long as the Fed is offering a rate above the market rate for these reserves. Okay. That was the reference to my excess reserves paper, which Michelle said you're going to get that. Yeah, European Central Bank also used to have an excess reserve problem, but it went away recently. How did they accomplish this? Let's see, it's in that last slide. Go back. The European Central Bank, I want the pointer, there we go. That's the exchange rate, dollars per euro, 1.34 currently. And you'll notice that the euro has not been outlandishly overvalued since just before the crisis began. The first column of figures is from August of 2007. And I think the high point for the euro was around 1.59 and the low was around 1.16, but the central tendency has been the same over these years. The measurement dates were August of 2007, September of 2011, that was just ahead of the final eruption of the Greek crisis, a terrible time in Europe. This is April of 2013 when I was putting the paper together, and this is current data last week. Okay, so required reserves, these are in euros, in billions. They started out with required reserves about 189 billion. They got as high a year ago, they were at 329 billion, and those are now back down to 211. The excess reserves grew from nothing, 0.1 billion or $100 million, to 358 billion at the peak, which in European terms is a problem of comparable magnitude to ours. And they were a year ago down to 312. What did the Europeans do to get rid of and now they're down to 22. What did they do to get rid of the excess reserves? And the answer is they raised the required reserve level in mid-year 2012 so that about half of the excess over time was absorbed into meeting the new required level. And then secondly, the banks gradually paid back the loans they had borrowed from the European Central Bank. And it goes back about a month now. They dropped to essentially zero. So that number in the last column was around 100 billion euros as recently as a month or a month and a half ago, but now it's down to 22. European monetary base, using the US definition of base, 925 billion euros, got as high as 1.8 trillion euros. Now they're back down to 1.2 trillion. Looks to me like they're gradually working their way out of the problem. What's the issue? In Europe, the head of the central bank has announced he's going to do what policy going forward? Mario Draghi, what's he going to do? He's going to print money, right? He's going to undertake his own version of a quantitative easing program. So what would you predict, based on what we've seen here today, will happen in the next column out there on the balance sheet if we revisit it 6 months or a year from now? I think that he'll have his excess reserves problem again, right? Because is demand greater in Europe than it is here? No, generally Europe's in a recession too, right? So in the absence of demand, if you print money, I think it winds up at the central bank as reserves. The European M1 at the end of June started out at 3.7 trillion at the beginning of the crisis, rose, it's now 5.5 trillion. So some of that reserve got out into general circulation. M3, which is the European number that's comparable to our M2, started out at 8.3 trillion. It's now about 9.9. The gold that the Europeans hold, the price of gold went up since the crisis. I think it was about $600 an ounce going into the crisis. Where is it today? About 1,300. And the Europeans mark their gold holdings to market value. We don't do that. We still show the official price of $42.22 an ounce. So European gold reserves are now about $450 billion at market price. And the total balance sheet of the European Central Bank, 1.2 trillion, got as high as 2.6 trillion. It's now down to 2.062 trillion, okay? So that's what the Europeans did. And now we can open it up for you guys. Yes?
Okay, go back to the slide you were just on.
The last slide? Yep, European numbers.
So this is, I guess, a two-part question. Can you remind me what the definition was of monetary base? And
It's just currency in circulation plus reserves at the central bank.
so how did the European monetary base okay, so the shrink in the monetary base was...
They have about 900 billion euros circulating. At the beginning of the crisis, the 1.2 trillion roughly, it was, let's see, where's base? I'm sorry, it's 1.2 trillion now. I looked it up. It's around 900 billion of euro notes in circulation, plus around, what have we got, 230 billion of reserves at the central bank.
And, So how did their monetary base manage to shrink so much?
When they raised the reserve requirement, what is the effect of that on money and credit? We tried that. I discussed this in my paper. We tried a similar thing in the 1930s. We doubled the reserve requirement starting in 3 stages, starting in 1936. And the effect was to induce a return of the Great Depression. Okay? So what happens to money and credit when you raise the reserve requirement? Let's say the banks are required to maintain a 10% reserve and you raise it to 15. It means they can make fewer loans, right? So the economy will perceive that as a shrinkage of credit available. And that will induce a slowdown of business activity in theory. And so that you wind up with a recession or stagnation. Now, at the time, the Europeans, you could say maybe they're a little more worried about inflation than we are. Let me ask you this. In living memory, have the European countries experienced serious inflations and even hyperinflations in a few instances? Yes, Germany and Austria in the 1920s. Hungary, almost endlessly. Italy has had it. As part of the Marshall Plan, for example, at the end of World War II, the U.S. lent $13 billion to Europe. It was real money back then. That was about 1/3 of the federal budget for the year the program began. So we let Europe $13 billion, and they had to use it in various construction projects and the like. And the secret of avoiding a debt buildup was we told the Europeans, you can pay us back in local currency at whatever the value is at the end of the loan. We're not insisting on payment back in the same dollar value that exists today. So some countries, the currency appreciated, Germany, the Netherlands, and they wound up with a surplus at the end of the Marshall Plan. Other countries, inflation was bad, and currency went to hell in a handbasket. When I was a student in France in 68, 69, the old notes were still in circulation from World War II, and de Gaulle had done a currency reform in the early 60s that essentially lopped off 2 zeros. So if you had a 100 franc note, it was actually a 1 franc note. But anyway, in Italy also the same thing. Before they adopted the euro, the lira was something like 1,700 lira per dollar. And the traditional value might have been, say 5 to the dollar. So that it shows you how bad the inflation experience is in Europe. But especially in Germany, if you go in and say, oh, what's a little inflation among friends, right? It's a non-starter as an argument. So in 2012, when the manager of the European Central Bank said, let's take some of these excess reserves out of the system because that's potential future inflation, and that's what they did. So they doubled the reserve requirement. They told the bank, start paying us back the European version of discount window loans, and they did that, and they got the monetary base down to where it is. Okay, other questions? Go.
What do you think the logic is behind the Federal Reserve's focus on purchasing the long end of the market?
What is the Fed's logic in going for the long end of the Treasury market and mortgage-backed securities? By the way, what's the initial maturity on mortgage-backed securities when they are issued? 30 years, right? 30-year mortgages are in the packages, so those things are 30 years also. So something like 3/4 of the Fed's balance sheet is tied up in paper that has a maturity of 10 years or longer, all right? And the logic was, if the Fed is buying long-term paper, what happens to the market price of that paper and the corresponding interest rate, which is sort of the reciprocal of the price. The Fed is buying the paper. What happens in the market? Price goes up. What about the interest rate? Interest rate goes down. So the Fed wanted to stimulate private investment in housing, for example, by reducing the long-term interest rate. Okay? And that was the logic that was going into it. How far did this go? Well, remember, I'm a lot older than you guys, except for them. But it got to this point recently. My mortgage on our house is with a traditional savings and loan run by an ethnic family in Cleveland. And about a year ago, we got this flyer in the mail that said, if you have fewer than 10 years to go on your mortgage, we want to talk to you. We will refinance you for 10 years at 2.59%. That's an unbelievable deal, right? But of course, you had to have a significant down payment too. I think it was 25%. So anyway, but for somebody in my position or these guys, you can refinance your house at 2.5%. So that's the effect of the Fed policy that you're talking about. Yeah.
What happens if we have a burst in long-term rates or a burst of inflation?
What was that?
What happens to the Fed if we have a burst in rates and or inflation, or both?
Right. What happens to the Fed's balance sheet and its income statement in particular if there is a burst of inflation or a spike upward in rates? And the answer is it's bad for everybody if that happens. The Fed currently earns right at $90 billion a year from all the securities that it holds in portfolio. What does it do with that? It costs the Fed about $2.5 to $3 billion a year to run the system. They deduct that. They pay a statutory dividend to member banks on their holdings of Fed stock. The dividend rate is 6%. And from a banker's standpoint, where else can you get an assured risk-free 6% return these days, right? So they're happy to hold that Fed stock. And they deduct that, and everything else, let's say you're up to $3.5 billion or something like that, comes off of the 90, and then the Fed mails a check for, or a wire transfer, for all the rest, say $85 billion a year to the US Treasury. Okay, that's a component of other income on the Treasury's balance sheet, and it affects the budget deficit. If rates go up, let's say the Fed had to pay 1% instead of 0.25 to hold those reserves at the Fed, that would roughly double the amount that the Fed is required to pay out in interest to the banks each year. And Bill Ford and I did a paper together here a couple of years ago about the effect on the Fed's balance sheet. Essentially, at 1%, half the Fed's earnings are gone that get rebated to the Treasury. And at 2%, they're all gone. The Fed is in a negative income position. So that you might say, well, is this worrisome for the central bank? And Bernanke and I guess it was under Tim Geithner, Bernanke and the Treasury made a deal where a letter was given to Bernanke saying, don't worry, if you're in a negative income position, we will allow you to credit the money owed to the Treasury as a negative reserve against the asset you hold, Treasury Securities say. And the accountants are all scratching their heads saying, well, what's that? because you're not supposed to show that kind of a reserve on a security that is otherwise deemed good, Treasury Securities, right? You're supposed to bring it on down in the income statement and show it as a loss, right? So the Treasurer said, no, we'll suspend the accounting rules so that it won't hurt the Fed, but at a 2% interest, now I'm a congressman. And I'm saying, I used to get $85 billion a year from these jokers at the Fed, and I'm not getting it this year. That means I have to go into the budget negotiations and find $85 billion that I can cut somewhere else, or we have to raise taxes to offset it. So how happy will Congress be when that happens? That's the real issue. It's the political problem for the Fed more than anything else. Any other response on that, do you think?
Well, think of the early 80s when we had rates way up. That might, duration of those mortgage backs is much lower than 30. I mean, the actual duration, because of the way mortgages turn over, would be more like maybe 7, 8.
Right. This is one of the arguments. He's referring to the early 80s experience with high interest rates, and that's covered in episode 1 of The Commanding Heights, by the way. But does anyone remember how high did interest rates go in the United States in the early 80s?
Above the Civil War.
Yeah.
17, 18.
It was about 21 at one point.
21. The prime rate went to 21. Okay? And the Fed was charging a discount rate of 18% plus a 3% surcharge for those who increased their borrowings to get you to 21. So 21% in the early 80s. When I first got a mortgage in New Jersey, when I was still working at the New York Fed, this was in around that time, 1981, I guess, and I think my first mortgage was at 14%. Okay? So it can get that way if the Fed misplays its hand. But an interesting thing, I noted that the Fed has quintupled the balance sheet over the last 6 years. In the 70s, in that run-up to the 80s inflation, Arthur Burns only doubled the balance sheet over an 8-year period, leading to that inflation, and this time we quintupled it in a shorter period. So if it blows, it'll be bad, and that's what the fans of gold tell you. What are your shelters in a hyperinflation? Gold, raw farmland, doesn't have buildings on it you have to keep up. Traditionally, timber was a shelter, but in recent years, you have to hire armed guards to protect the timber from thieves. And the farmers would tell you also cattle are a traditional shelter, but these days, cattle thievery prices are so high that thievery is bad, and so you once again have to hire armed guards to keep the cattle.
Rustlers?
What was that?
Rustlers?
Rustlers, yes. So anyway, so what's your shelter? And the answer is raw farmland and gold. And I don't advise anyone to get into farming who didn't grow up on a farm, because you won't understand what you're getting into. And at the same time, Iowa farmland, there are trusts that invest in Iowa farmland and sell shares of the trusts overseas, Japanese and European investors primarily. But yes.
Why didn't you mention Treasury inflation-protected securities, and why can't the Fed absorb?
This is good. No, this is a good question. Yeah, yeah. Doesn't the Treasury offer Treasury inflation-protected securities called TIPS these days? And the answer is yes, that is. They didn't exist before the mid-90s, And a friend of mine who spoke here a couple years ago, Robert Hetzel at the Richmond Fed, wrote the seminal papers here about that persuaded the Treasury and the Fed eventually to start offering those things. So you can buy, I think the shortest maturity is 5 years, but 5, 10, 20, and 30-year Treasury inflation protected securities. And on paper anyway, that's a good idea too, because they're supposed to correct for the amount of inflation at maturity when you cash them in, okay? So they're also a good thing, but you have to trust the Treasury to be willing to pay off on that glorious day. So.
Those are best held in a qualified plan because as inflation goes up, they treat the kind of increase in that base for inflation as earned income as you go, so that taxable income, so that if you buy them, you really want to put it in a qualified plan, not in a regular brokerage.
Right. Neil used to work in the insurance industry, by the way, but he was saying essentially that as that inflation correction is paid through, the Treasury, the IRS, would require you to report it as current income and pay full tax on it. It's not a capital gain, and therefore your best bet if you buy tips is to put them in your 401k or your IRA account, a qualified plan. Let's see, question back there.
In the paper you mentioned tips, and it looked like the interest rate is not keeping up with inflation. Or did I misunderstand?
Right. The question is essentially, does the interest rate attributed to tips actually compensate you for inflation? And an argument can be made, at least in recent years, no. In fact, at the shorter end of the maturity schedule, the 5-year securities and so on, the interest rates on tips are strongly negative, like -1%. And what does it mean when you live in a negative interest rate environment, by the way?
Government gets it.
Well, it's deflation, essentially, right? And there are two schools of thought. If you run the Fed and you like fractional reserve banking, you hate the concept of negative interest rates. You don't want to deal with deflation at all, okay? What about in classical economics or Austrian economics? How do they feel about deflation? It's okay. In theory, if the price level is going down, the cost you pay to buy things should be going down. And whatever your current income is, as long as you can reasonably maintain it, you'll be slightly better off. The United States experienced a period of prolonged disinflation, mild deflation, at the end of the 19th century, roughly from about 1878 to around 1896, when the price level was falling gradually throughout that time, and the main complaints were from farmers who had signed fixed interest rate contracts, borrowing money back in the 1870s when the expansion was still going on, and now they were being asked to pay the loan back in harder currency, much harder to get. And so that gave rise to the populist movement in the United States. And as an old farmer, I'm sympathetic to that argument myself. But the right answer is, that's where government should kick in my view. Take a baseball bat in one hand, the head of the banker in the other hand, and say, look, you're in a deflationary environment. I think you really, really, really need to, quote, voluntarily, end quote, index the interest rate on those loans, okay? and then everyone is restored to status quo ante. In fact, in the face of deflation, governments tend to play horrible games. In Argentina and Brazil, in the 90s, they seized savings accounts. So they would say, remember that nice savings account you had at the bank? Well, here is your 5-year government bond to compensate you for that savings account, which we've now taken into government reserves. Okay? And that's one of the suggestions that is quietly voiced from time to time internally about what to do about the reserve problem here, and that is you could turn around and tell the bankers that, what's the excess number? Two and a half trillion roughly is the excess right now, and so that 2.5 trillion will just get moved over to the Treasury's deposit account, and in turn, the Treasury will mail you guys all a nice 10-year bond. Wouldn't that be fair compensation? Anyway, but so you got to watch out for games like that.
And who pays?
For that 10-year bond, you mean?
Doesn't they have to raise taxes?
Well, ultimately, the Fed either has to inflate or raise taxes to pay off that 2.5 trillion that they just seized, and that's right. Yes?
So this is all making me think about, what I want to do to hedge against potentially very high inflation. And wouldn't it also make sense to start taking out a lot of debt right now, especially if you're young, so that the value that debt will deflate?
Only if you can get it at, the question is it worthwhile as a betting game to take out a lot of debt right now, especially if you're young? And the answer is yes, maybe, but I think you want to borrow only an amount that is reasonably within your income capacity to pay. Fixed interest rate at today's lower rates, no future adjustments. That's not a bad bet in my book.
What about mortgages?
Same thing on mortgages that,
You have a house.
but you don't want to go too low on the down payment requirement. I think if you refinanced and the result was you have less than 25 or 30% equity, I wouldn't do it. And also, you don't want to refinance for longer than about 15 years, I think, in the world that we live in. I'm in touch with people in Washington who are trying to reform the mortgage market, Fannie Mae and Freddie Mac in particular. And I'm told that if the Republicans win the Senate back, Richard Shelby would once again, of Alabama, would once again be the chairman of the Senate Banking Committee. And he actually is a quite intelligent man. He was the Chief Justice of the Alabama Supreme Court before he got elected to the Senate. And he understands economics reasonably well. During the TARP debate in fall of '08, does anyone want to know, here's Shelby, he's the ranking Republican on Senate banking. What was his position on TARP, which essentially was a $700 billion bailout for the banks?
He was against it, I think.
Not only did he oppose it, he was not a quiet opposer. He let it be known that he thought the bill stank and wouldn't have anything to do with it. So the White House, which was Republican, Bush at the time, had to go find another senator to carry the bill on the floor of the Senate. They found Senator Judd Gregg of New Hampshire, as I recall, and he was soundly defeated the next time he ran for election. But anyway, Shelby wouldn't have anything to do with TARP. So he'll come back. And that gives some hope for the reform of Fannie and Freddie and the mortgage market. The reform that what we'll call the think tank crowd on the Republican side is trying to cobble together is something like 20% required down payment minimum. To help you get there, the government will issue bonds like TIPS, but There will be special designated savings bonds for a mortgage down payment. And you can buy them as you're young. Once you hit 10%, some kind of insurance program, whether it's private or government, is yet to be determined, will be made available to help you get to a 20% down payment. And then you can refinance. Then you can finance yourself. Also, instead of a mortgage interest deduction on your house, you will be given a principal amortization tax credit, so that if you pay off $1,500 of principal in the year, maybe you'll get a $375 tax credit, which would have the equivalent tax benefit of something of that sort from paying interest on the mortgage. And the longest term allowed would be about 15 years for the fixed rate mortgages. Okay? So that's, I think, what will come out the other side if the Republicans win the Senate. Running out of time. One last question, anyone? Okay, hope you learned a lot about the Fed today. And when you're a governor or a Reserve Bank president or the senior economic advisor at a Reserve Bank, now you'll know what to tell those guys, right? So anyway.
Thank you all.
Okay, thank you.